Hey all, welcome to ShareTreck. This is Raj here. I'm asking myself the question, are we on the brink of a major market sell-off? And I bet you're asking the same question to yourself and any of your friends you have around you. I'm going to look at a few charts that are making their rounds in the community and on social media. And I'm also going to look at S&P 500, Nasdaq, VIX, and the 10-year yields and give you my thoughts. And I would like to hear from you guys what you think. Please make sure that you interact and put your thoughts in the comment section so that it can be as useful to me as this video is to you. With that, my friends, I would say that we need to talk. Over the past 2 weeks, something unprecedented has happened in the stock market. Hedge funds have dumped stocks at the fastest pace on record, and even faster than the 2022 bear market or the COVID crash. And it's not just a technical sell-off. Economic data is collapsing, particularly in the consumer sector. So what's going on? Is this just a correction, or are we looking at the beginning of a much bigger downturn? Today, I'll walk you through two critical charts that every investor needs to see right now. Part one of this is that consumer and soft data are plunging. Let's start with the first chart from Goldman Sachs Global Investment Research, which tracks macro surprises in the economy. This measures whether economic reports that are coming in are better or worse than expectations. Well, look at this chart out here. It's from Goldman Sachs Research. And I've taken it from social media. I'm taking it on faith that this is a genuine data. And the orange line out here represents the soft data, things like consumer confidence and business sentiment. And you can see that it is falling. It was up and it is coming down. And if you see the consumer sector surprises, it's the dark blue line, which has completely collapsed. You can see this area out here, it's collapsed, gone negative. And meanwhile, the hard data, employment and retail sales, which are also having lags, they have been held up and they're also dropped, and it's behind the sentiment. So what does this all mean? Consumer sentiment is tanking, people are spending less, and confidence in the economy is falling. Survey-based indicators are deteriorating, business expectations are worsening, and companies might start cutting jobs or investment. And we have seen this before. Soft data often leads hard data. If this trend continues, we could see an economic slowdown materialize in the coming months. This is already bad news for the market, but it gets worse when you see what hedge funds are doing in response. So I'm going to show you a chart here, which is the second chart. And this chart is also coming from Goldman Sachs. In this chart, it's basically tracking the hedge fund net flows, meaning whether hedge funds are buying or selling stocks. And right now they are selling more aggressively than ever before. And the red box highlights the biggest 2-week hedge fund sell-off in history. And the outflow is even larger than the 2022 bear market and the COVID crash. The biggest selling pressure has been in US equities, despite the S&P 500 only being down about 6% and Nasdaq 100 being down around 9%. So what does this all tell us? This tells us that hedge funds are likely front-running an economic downturn, reducing exposure before consumer weakness translates into slow corporate earnings. And the intensity of this sell-off suggests fear and de-risking, even though major indices haven't collapsed yet. Institutions could be positioning for weaker earnings, higher volatility, or a bigger market decline. So let us look at the next graph. This graph, I'm going to just make this a little bit bigger because this looks small on the screen, and I hope you're able to see this. This is picked up from gurufocus.com. This graph shows the historical Shiller PE ratio, also known as CAPE, or cyclically adjusted price to earnings ratio, from around 1880 onwards. The print is not out here, but 1880 could be somewhere out here, and all the way up to today. The key observations are that the current Shiller PE ratio is 35.3. It's above the all-time high historical average of 17.6, shown here with the dark black line out here. red horizontal line represents a threshold level that historically indicates overvaluation around 35 to 36. We are above that right now. These are the notable peaks in the ratio. A peak in the mid 1920s indicated that we had the 1929 market crash. An extremely high peak around 2000 indicated to us that we had the dot-com bubble happening around that time, 2021, 2022. The current level, 35.3, approaching previous peak territory, is also another flashing warning out here. The ratio has spent most of its history below 25, with values above 30 being relatively rare, as you can see out here. And the Shiller PE ratio is calculated by dividing the current market price by the average of 10 years of earnings adjusted for inflation. It's designed to smooth out short-term fluctuations in the corporate earnings and provide a longer-term valuation metric. The current elevated level suggests that by historical standards, the stock market may be overvalued. When the ratio is significantly above its historical average, as it is now, it often has, though not always, indicated lower future returns over the following decade. This doesn't necessarily predict an imminent market crash, but it does suggest that stock market valuations are stretched compared to historical norms, which might warrant caution for long-term investors. So what happens next? Two possible scenarios. Scenario one, which is kind of a market rebound. Hedge funds may have overreacted, and once selling pressure subsides, market could stabilize or even rally if economic data improves. I think that possibility could be determined when we touch the 200-day exponential moving average. We have been bouncing off it in some indices, but we'll have to see if we are able to sustain a movement upward. That would indicate that we are in a good situation. Otherwise, it could be the precursor for further downward fall in prices. Thus, retail investors and long-term institutions might absorb the selling, preventing a major crash. That would happen if we bounce off the 200-day exponential and start creating higher lows and higher highs. So that's the outcome. The key indicator to watch is that if hard data, that is employment, retail sales, GDP, remains stable, this could be a short-term correction. Then we look at the scenario two, which is a bigger market decline. If hedge funds are right about the downturn, this could just be the beginning of a more serious correction. Consumer weakness could spill into corporate earnings, leading to lower stock valuation. And if hard data follows soft data downwards, the Fed may be forced to cut rates sooner rather than later, but not before stocks take a hit. And I would like to give my own thoughts over and above this analysis. I don't have hard data to do this. This is more of my gut feeling based on what I experience in the market along with you when I read news and when I see all the indicators out here. It's basically that since Trump has taken over, he has created a lot of volatility. He's created a lot of uncertainty, which is called the uncertainty premium, which weighs down on the stock and weighs down on the economy. Now I'm going to elaborate a little more on the uncertainty premium. Imagine you're a small business owner and you are actually let us say you are a farmer, or maybe you are a grocery retailer, a small business. What do you have to do in order to grow your business? You need to have a good understanding of the operating environment, which is basically government policies, the price of set up by the competitors, your own internal cost factors like employee costs, inventory costs, and so on and so forth. And based on all those things, you are on a steady track, placing orders for the right amount of inventory, pushing for the right amount of sales for the right consumer segments with your advertising and everything. Running a business requires a lot of work, and most of the work is focused around understanding your market, understanding your operating environment, understanding the policies that govern your business, and then coming up with your best practices and rule of thumbs in order that you order at the proper price at the proper quantities and you sell at the proper level and the proper rate. And that's how businesses work. And when Donald Trump starts talking about a reciprocal tariff, which is across the board, across the globe, and talking about specific tariffs of 25% and then carve out exemptions and all those things, it creates a lot of difficulty for all the business owners, small business owners, farmers, everybody alike, because now they need to account for what is the new rules and the new policies. It's not so easy because there are point of sale systems which need to be modified to change the costs. There are point of sale system which need to be modified to account for the taxes, importers and exporters, people who book the freights, shipping containers, supply chain operators, all of them face whiplash. Because today Trump may say in the morning that he's going to put the tariffs as of Monday, and then maybe 4 hours later that maybe Lutnick comes out and says Trump is a reasonable man, he's looking at all the data, and maybe he'll come and meet us somewhere in the middle and we'll come up with a compromise, and there won't be postponement but final decision on what the tariff is going to be or whether it's not going to be. And then 4 hours later Trump comes and says he's going to impose another 250% tariff on Canadian dairy. So all these things has created a lot of fatigue. And I'm thinking that all of this is going to reflect in the next quarter when we get the employment numbers and the earnings. Because many businesses which are thinking of expanding are now saying, okay, hold on. We don't have any clarity about what's going to happen next. So let's not invest. Let's keep the money handy. And let's not take any decisions. This means new orders for capital equipments, new orders for commercial premises, new recruitment of staff. All of those things are put on a hold. So growth is being put on a hold. The other thing that's happening is that people are already doing business and looking at these kind of situations are now saying that, okay, my margins are very less and I can't eat this much of tariff. So why don't I start letting go of some stuff and reducing my footprint so that I don't eat into my margins? Now, these kind of sentiments will be there with more of the small business guys as compared to the bigger ones. But all of these things will add up. And we are going to see those hard data come up next quarter. So all the companies that are being valued on PE are now being sold off because the earnings are going to be less. And even if you have the same PE multiple, but with a lower earning, you're going to see lower stock prices. And I bet that's what is happening right now. So even if we bounce off the 200-day exponential today, I don't think we have to be confident that we are going to bounce back up again, because Trump still has got a 4-year mandate, out of which is hardly done 2 months. In 2 months, we have seen all these things happening. You will also see geopolitical changes that are taking place, and that could also lead to a whole lot of instability. For example, Trump withdrawing from various areas and realigning himself away from Europe and other trusted allies that we already had from before means that all the maritime routes which are being used for shipping inventory, they get open to Somali pirates and other destabilizing agents, and therefore reliable supply chains are going to be coming under strain. So all of this put together, I'm thinking that I'm a bear right now. So having said all that, let me take you to the TradingView platform and let's look at all the major indicators. I'm just going to look at Nasdaq and S&P 500, the VIX, as I said, and the 10-year yields. And that's all we are going to do. And then I'll have some concluding remarks, and I look forward to your feedback. Let's go to TradingView now. Well, friends, here we are. I'm going to show you the TradingView platform S&P 500 monthly chart, which means each of these candles is a 1-month candle. And I'm looking at a long-term picture starting from 2006 onwards and going all the way to today. Now, that is one of the biggest falls that we had out here in 07. And I'm going to just take a measuring widget to give you the quantum of drops that we can have. So we had a drop of around 53.23% out here, which started on 1st of October 2007. That was a very severe drop. Now we could have that kind of a drop as well because we have got policy induced turmoil, which is very difficult to solve as compared to economy related turmoil, which can be handled with rules of thumb using financial and monetary policy. Remember, even Jerome Powell said that he's waiting and watching for policy clarity before taking any steps. So if the Federal Reserve chief is not in a position to understand what the hell is happening, what happens to retail investors, hedge funds and others, regardless of how many sophisticated models and all you may have, what you don't have is what Trump is going to think next and what he's going to announce next. So to that extent, that is causing volatility and that is causing a lot of problems. And I wouldn't hesitate to say that we could even see a 53% drop if he comes up with something which is really, really bad for the market and the economy. Those kind of things are entirely in the realms of possibility, because without Trump, we have had 53.23. with Trump, that's a possibility that we could have. Now, having said that, I'm also showing you this very long-term chart because we can still look at a drop which could test the long-term support. So I'm just going to magnify this so that you can see this properly, recalibrating it. Now we could go all the way down. Sorry, let me take this widget again. So we are here today, and we could go all the way down to somewhere out here, and still we would have fallen only 23%. And what is this yellow line? This yellow line has been coming with us for a very long time. It's a support line. So we are still on a bull channel for a very long time on S&P 500, despite dropping so much. If you take a very long-term view of this market, so a drop of around 27% from where we are right now is not ruled out. And what is supporting us is this yellow line, which happens to be the 200-day exponential. Now, having said that, I'm going to go and drop down to the 1-day time frame so that we can have a near-time review of what's happening with this market. So this white line that you see here is the 200-day exponential moving average, and we have touched it the previous day. And on Friday, we dipped down below it, went all the way very close to the support at 5,659 and bounced back up above the 200-day exponential moving average. To me, the 200-day exponential moving average holds a very significant level. Some people may say that I don't care about it, but I think personally, I feel that that's a big milestone. If we break down below that, then we have a support out here at 5,659. And right now, so far, we have had a drop, I'll say from there to here, of around 6.09%. So we are still not in correction territory. Once we touch 10%, we'll be in correction territory. And let me draw a widget from the top there all the way down to this line of support out here. So if we come down all the way here, it is still 7.93%. So even without a correction, we are perfectly capable of breaking the 200-day exponential moving average and also the line of support that we have here at 5,659. So that indicates to me that it's very much possible that we could break down below the 200-day exponential, as well as we could break down below the support of 5,659, and that could take us down further. So that's my immediate conclusion. I'm just looking at what's likely to happen on Monday, and I think that a downward trajectory is quite possible. It's also possible that people have started selling off based on the expected PE going forward. There could be a lot of people who may be thinking that this is the end and therefore this is as low as it goes, let's buy up. So that could give us a dead cat bounce, but then we are going to come back down either after hitting the resistance at 5,779 or after hitting the resistance at 5,841, because all the turmoil that we are seeing can be traced back to one source, that is the White House and what Trump is doing with the tariff talk and the other talk that is having, like taking over Greenland, controlling the Panama Canal, taking over Canada and making it the 51st states. These are all not jokes. These are all very, very serious topics, and they can have massive repercussions for the US dollar itself. Now, having said that, let's look at Nasdaq. Nasdaq is still in a bear channel, in my opinion. It's not been able to break through this diagonal line of resistance that is coming with us from a previous bear channel, and it is just above the 200-day exponential moving average and still below this diagonal line of resistance. And we managed to touch this line of support out here at 19,700 and bounce back. And MACD is bearish, but it's trying to improve. Momentum has been moving sideways. It's still below average, so I'm thinking that Nasdaq definitely has the potential to, at the very least, pierce this support at 19,700 and then test the support of this diagonal line of support from the previous bear channel. And I have also plotted a double top out here, and the double top target takes me to 19,049. Okay guys, I'm sharing all of these things with you very bravely as a retail investor, knowing fully well that I may be totally wrong and things may go the other way around. But in return, I want you guys to share your thoughts and your ideas in the comment section with me. And now I'm going to look at the VIX. VIX is elevated. Whenever VIX is elevated, the share market falls. So we are having elevated VIX with plenty of room for further elevation going up. MACD is still bullish but not super bullish, so there is room for it to go up further. So I am thinking that VIX could continue to stay volatile because we have a volatile political environment. Policy environment is crazy. None of the participants in the economy are able to make any sense of this. Day is night and night is day, up is down and down is up. So things are not clear. Now let us look at the put call ratio, which again seems to be almost neutral out here. And we are going to look at gold, which currently is at 2,909, and my prediction is that after bouncing down on supports, it's going to go back and challenge 2,952 and move upwards towards around $3,000 in the next 1 month or so. That's my prediction for gold, in line with my sentiments at this point of time. Here we have the US bond. I'm looking at the 10-year bonds. It's a daily chart, and as you can see, there is this line of support out here. Bond yields are going up, and they are just being held down by this 200-day exponential moving average, which has been checked 2 days in a row. And if the bond yields start going up, then more and more people are going to start investing in the bond, because given the risky environment, that's a very safe place where they can have high returns. And therefore, that's where the money will start going, which means that the stock market has more reasons to decline. So this is the summary of what I have out here. So the question is, where do we go from here? Here are three things that I think that I could do right now, and maybe you could also consider. First is watch the consumer spending trends, the retail sales and sentiment report, which will tell us if the consumer slowdown is real or not. And I suspect that we are going to get bad data in that area, because the Fed layoffs have not yet figured into the unemployment data. And when they start coming in, it's going to look real nasty, because not only have the Fed layoffs happened, but the private sector, which was supporting those Fed sectors, have also laid off people. So the combination of those two is going to look really dreadful. And I would also stay cautious with high risk growth stocks. And if hedge funds are right, we could see a rotation out of speculative names into safer assets, which I would say would be consumer staples and utilities. And that's what I'll be looking at. And one has to prepare for higher volatility. Even if this isn't a crash, markets could get more choppy in the coming weeks. And that's what I'm thinking after looking at all the circumstantial evidence and all the charts that we have and all the indicators that we have seen so far. So I would like to get a feedback from you. Are we about to see a bigger sell-off, or is just the hedge funds panicking? Drop your thoughts in the comments below, and don't forget to subscribe for real-time market updates. And friends, before I go, I want to request you to join us on the pre-market live stream at 7:30 a.m. Eastern time, and you can join me there on weekdays. And out there, I will also take requests from you to analyze any of the tickers, a technical analysis, very quick technical analysis on those tickers. And some of the subscribers are already out there joining me and making requests. So I look forward to see you there soon. And I look forward to your feedback on what the hell is happening with the markets. Thanks and have a great day. Bye for now.